Hello and welcome to Volland Refined. I am Jason, the Wizard of Ops. With me all day today is Hunter Edmonds. Today is our all-day live stream that showcases the brand new features available at Voland with a wide range of special guest appearances during 8 live segments. If you're joining us on YouTube, you can go to the description of this video to get the links to all 8 segments. So joining us now is Henry Schwartz, Vice President of Market Intelligence at Cboe Global Markets. Henry is a seasoned trader, innovator, and derivatives industry thought leader, and he joined Cboe following its acquisition of Trade Alert, a market data company he founded after 15 years in the industry. I met Henry about, 2.5 years ago in Nashville, right? And
yeah,
I mean, we've it's been fun. Jill kind of calls you my secret boyfriend because when we start talking data on the phone, it's like I get all excited and we get so it's fun though. We're both data geeks, and I'm pretty sure we're going to get wonky in this segment. So first, Henry, I want to talk a little bit about the Valera data feed that now feeds Voland. That pretty recently we've decided to transition that feed to Cboe, and I want you to tell us a little bit about it and what Cboe provides.
Sure. So I agree. We both love derivatives, but we also kind of love coming at the things from the data angle. And you know, if that makes you happy, then options is kind of the place to be, because the amounts of data. Last I looked, we were around 200 billion messages a day in terms of quotes and trades. And that's, you know, across all 18 exchanges. There's an enormous amount of data, and that's one of the reasons that it's important. And this was, you know, the platform I started at this point 20 years ago was to kind of help simplify things when there were 5 exchanges. Now there's 18, soon to be 20. The Trade Alert, my firm got bought in 2020, and Cboe also bought a firm called Hanwick Analytics, because Hanwick was actually doing some amazing things in terms of real-time modeling of the entire options market and turning basically that fire hose of data into kind of, you know, the intelligence people need. The basic idea, right? You know, most people are pretty familiar with a binomial or a Black-Scholes model, right? Modeling options is not hard. Doing it at scale actually is hard, and you know, it's the nitty gritty where things get kind of gnarly, right? The dividend yield, which actually goes into, even goes into the S&P 500 modeling. You actually do need to know what the div yield is of the S&P 500 to model things correctly. So, you know, everybody knows about volatility curves, but you got to have, all your inputs have to be accurate. You have to have good interest rates, and not just good, but good and fitted and smooth, and things that aren't moving around and causing issues. And same thing same thing in volatility and all the other inputs. So the Valera feed is a kind of, you know, industrial strength feed of the option flow, quotes and trades that include the modeled Greeks, basically. So you get every single trade, and you know what the theoretical value was of the option at the time, which helps to identify buyer versus seller. And that was one of the very first things that I kind of fell in love with, is this concept of order flow, like because, you know, in an electronic fragmented world, you have to use some you know, you have to use a robust system basically to make sense of. I mean, the last I looked, I know that on October 10th, which was the record day for the industry, there were over 7 million trades that traded that day. So that's a lot, and every single one of those trades has information in it, right? So so the Valera feed basically is that. It is every single trade, is every single quote. It's basically the information so that you can model and track order flow, and that's, you know, that's what you're getting. And I can't say it strong enough. The kind of infrastructure needed and the quantitative approaches needed to do that correctly for the entire market takes a lot of firepower. And so we have a team of I think there's about 45 people on the Hanwick team, you know, making sure those analytics are correct. It feeds, you know, it feeds all of our internal platforms. It's used for risk management at some of the biggest brokers.
That's incredible. And 45 people. I think I've spoken to half of them already, but while we were hooking up, I mean, I think that we are it feeds a lot that we do. And not just the 45 people, but the server farms that you guys have has removed that kind of technical constraint of timing, of update times. We've had to, bring in trades, calculate a fair price, categorize ourselves. Doing all this ourselves takes a long time, and we didn't have the compute for it. So when we had Volland 1, our technical constraint caused us to have tiers based on update times. But now with the Valera feed, we are able to update a lot quicker, and because we have not just those 45 people, but those server farms and Secaucus and Chicago, and
Well, and GPU technology, right? You hear about that for for the AI world. It's the same. Enwic's been using GPUs for about 15 years.
Yeah, and yeah, so I mean, it's been a godsend for us. So again, thank you for helping us out. So let's pivot a little bit. You were talking a little bit about order flow and its impact on markets. Let's talk a little bit about market makers, dealers, however, wholesalers, however you want to term them. What is their process? How do they accept liquidity?
Sure. So, I mean, I started as actually a market maker. That was my first job in the business back in the 90s. I did that for on the floor for about 5 or 6 years, and then electronically for another 3 or 4 years at one of the large banks. The market maker community is providing is continuously streaming the bids and the offers that you're looking at on any option quote montage. They're very kind of technology and capital intensive firms, and the way the market has evolved is they're now basically multi-billion-dollar firms. There used to be some small groups in the mix with some good technology and skills. Now it's generally very large firms that do this with you talk about server farms. Somebody estimated the cost to be a market maker currently is about $110 million a year in technical spend in technology. So that doesn't include the people you have to pay and the business you have to run. That's just simply connections to the exchange, all the hosting and servers you need to run. It's not a little business anymore. And the market makers, but they're still doing the same thing. They're posting bids and offers, and they're getting hit on their bids, and they're getting lifted on their offers. And it's very sophisticated. There's also a lot of complex orders that are trading. There still is a floor. There's Cboe runs the original Cboe options floor in Chicago. But there are actually 6 trading floors in the business currently. So you have an enormous amount. Majority of the activity out there is electronic across all of the exchanges, but there still is a trading floor with people standing. So those same firms that are pumping quotes across 18 markets, they also have, most of them have a team on the floor for kind of the big orders, the complex orders, the things that might not be suitable to go through an electronic route, or basically in a lot of cases the executing brokers, they don't want to do it electronically. They want it to be a little bit opaque in terms of what the structure really is. And so, these market makers, there's another whole kind of ecosystem to this, which is the way that the retail order flow is routed through consolidators nowadays. So every single order that goes to kind of a retail broker that you would think of, such as Robinhood or Fidelity or Schwab, it doesn't go to the trading floor directly or to the matching engine directly. It goes to a market maker, which runs an order consolidation business, kind of as part of it, and they actually take every single order. There's about 7 or 8 firms that do this. They're competitive, but they'll take any order. They basically guarantee that they're going to execute it at the best possible price, and on top of that, they guarantee they're going to improve the prices a certain amount of the time. So if you've ever traded, an option and something that's 10 cents wide is 3 to 310, and you go out to buy a 3 lot and you get filled at 307, that's because it went to a consolidator who is living up to their promise to improve the pricing. And the reason they can do that is pretty interesting. They know the order's coming from, say, Robinhood, and they're not afraid of that order flow. And because they're able to kind of make these deals, that price of 307 might not be available to everybody, but it is available to the retail brokerage firms that they are comfortable trading with and kind of have deals with. So that's a big piece of the business. That literally is the reason that you can have some of these big brokers such as Robinhood, offering free commissions. It's also kind of the reason that the business has exploded. I mean, this year we're running at like 70 million contracts a day for the last month or so. Before COVID, it was basically about 18 million contracts a day. So so business has exploded. The market maker community, like I said, they're multi-billion-dollar firms. This is all they do, whether it's zero-day options or longer-dated volatility modeling. This is what they do, and you see the kind of the results in basically the tightness of markets and the amount of activity we're seeing.
Okay. I mean, the 70 million number, I see that all the time. The average over, I guess, like the past month or two has exploded. It just keeps exploding. People were talking about COVID as introducing options to people, and it is not tapered off since COVID at all. So they accept all this liquidity. They're hitting bids and asks, but then you're talking about that they have to hedge out their risk because that's how they're making their money is on the spread of the bid and the ask. Even a little bit of price improvement. How do they hedge out that risk? Like, what's their tools?
Sure. So that this is, it's initially in the olden days, right? Almost every option trade was kind of resulted in a stock trade. So if I was a market maker and you bought, 100 lot of Microsoft calls from me, I would actually immediately go buy a certain amount of Microsoft stock that, basically I use the delta of the option, and you hedge that delta because the market maker is trying to basically realize some bid offer spread. But while they're waiting for the seller to come along, they don't want the delta exposure. So the simplest way to hedge is an underlying hedge. So now in reality, that's evolved to the point, and in fact, even back in even going back 20 years, people realized that every time you go to trade a hedge, there's a little bid offer that you're paying, right? The stock has a bid offer too. So there's kind of a reluctance to. You certainly don't want to over trade. Like I said, you could hedge every single option trade 30 years ago because the options were 25 cents wide and there was a lot of kind of edge to begin with. So even if you paid 3 or 4 cents away in the stock, you were making money. Now, when we're down to basically penny or 2 penny wide options, and you're going to be paying away more of that spread. You just don't have much spread to start with when you go hedge with the underlying. So the market makers are pretty sophisticated, and they basically kind of, if you think about it, like, yes, the underlying is certainly a hedge, but there may be better hedges. Basically, a different option is actually the preference. Okay, so if I sold you some Microsoft calls, I'd like to go buy some other Microsoft calls that would cover that delta, also covers some of the other Greeks, right? You've got volatility risk, you've got row, you've got the Greeks, but the Greeks better than I do at this point. And options hedge options the best. So and then there's also things like ETFs, right? If I sold you Microsoft calls, I might go buy a tech ETF instead of going to buy Microsoft. So there's a lot of modeling going on in terms of what's the optimal hedge, and in some cases they don't hedge much at all because there's also the kind of this whole thing. Well, I sold you some Microsoft calls, but I'm comfortable that there's going to be a seller coming my way sometime soon, so I might just warehouse that risk. So in the index world, it's slightly different, right? There's no S&P 500 that you can just go buy. There's futures, there's the SPY ETF, there's correlated instruments, and so there's kind of a mix. And then there's all these correlated options, right? If I sold you calls in SPX, other SPX calls might be a good hedge, but SPY calls might be a good hedge. There's other similar instruments. So the the simplest way to think about it is like, yes, an option trade, it may result in an underlying trade, but there's nuance to it, and it used to be 70 or 80% of the option trades were resulting in underlying trades. Now the way, with the sophistication of the market makers and the fact that because consolidation is because there's a smaller number of much larger market makers, they're also kind of getting more of the flow. So, I mean, there are buyers and sellers all day long in our market. There is order flow. There's kind of a net direction. And, we can talk about that. People pay a lot of attention to that. But there is, in general, there's also it's generally pretty two-sided. If it wasn't generally pretty two-sided, the market wouldn't be kind of as kind of successful as it is, because it would all be going one way.
Yeah. So I also, you said that sometimes dealers will warehouse that risk. Every time I've gone to an event, even, like OIC or anything hosted by Cboe or something, and I talk to a market maker, current one, and I say, so how strictly do you hedge your Vega risk? I usually get a chuckle or a laugh to start. Because many times they're selling options, to people, and if they feel comfortable, maybe with their book, or if they have insight into the pricing, they don't necessarily, they could collect that data a little bit and try to mitigate their try to gain, I guess you could say, on that side. So, and that's kind of why, and in Volland, if you kind of look at a lot of our learning and stuff like that, we focus a lot on Vanna, because not all that Vega risk is hedged, but then there's like a conversion from Vega to Delta as time goes on, or as there's vol compression, and Delta is very heavily hedged. So it's, that secondary Delta is kind of the edge that we try to expose.
I mean, you're exactly right. And when I first worked at a couple different banks, there's always a lot of French quants in the derivatives business. That's been a kind of a fixture for many years, and they would tend to say, I don't trade Delta, I trade Vega. They don't want a Delta position. They're not trying to decide where the market's going to go today or this week. They are trying to decide and take the risk in the volatility, which is exactly what you're saying. Is there's an appetite for that, and why, right? It is a kind of mean reverting measure, meaning if VIX is at 50, we all know it's going to go back down to 30 or 20. We don't know when that's going to happen, and and if VIX is at 12, we all know that it's going to get to 30 or 40 at some time in the future. We don't know when, but so that's why these there's a lot of firms, market makers, banks, prop, that's the Vega is the position they want. And you are exactly right. As the market dynamics move and time passes, that it does translate into the activity that you've keyed in on. And I remember when I first met you, I was like, this is a thing. It's a thing we've known about for a long time, but it's not well understood.
Yeah. Go ahead, Hunter.
So thank you for coming in today, Henry. One of the larger questions that I've had is, we understand sort of dealer hedging dynamics where, they want to get the Delta hedge, they're getting flow come to them, whether they're on the bid, on the offer. One question that sort of stuck out to me is that we know that these market makers are hedging, whether they're warehousing it, they still have that position on their books. Now, what happens to a hedge when we get to like a large expiration? When those options do expire, we get to like a monthly OPEX, maybe it's a quarterly, even with stocks to the index side. What happens to those Delta One hedges that they have as soon as you go into a large expiration?
Right. Well, you're exactly right in the fact that there's things get interesting into an expiration, right? So if it's if you're talking about stock, or ETF options, right? Those are physically settled. So if you have deep in the money calls, they turn into stock. There's actually not much of a kind of a risk change for the dealer or the market maker, but they're not really in the business of being long stock. So as I said, people are trying to trade derivatives because they're they want the dynamics of a derivative. With the index, as you go into big options expiration, this is why, you know, actually technically this is why we call it, you know, the triple witching Friday, because it does tend to be more volatile. So basically, if you're short a bunch of calls in the index and you do have a hedge on general, you're going to be long futures. Okay, you might be long something else, but for the index, because you know, SPX is the S&P 500, whether it's the futures or the options, they track perfectly. And the futures are very liquid, so it is kind of the go-to hedge. Basically, if you've got a big position that's in the money and it's expiring, you need to get out of those futures. So there's a couple of different ways. I mean, sometimes, you know, you trade out of it. You know, sometimes you take your time to trade out of it, but that is kind of risky, right? The market can move pretty quick, and there's also this whole dynamic of like, well, I got the same position on that this other big market maker does, and so there's a little game theory going on. You can do an exchange for physical kind of thing as well, like a market on close order to basically exit those futures. But it's funny that, like, in the kind of going back a few years, everybody pretty aggressively traded out of their expiring positions. Nobody wanted to go into expiration with something that you know, that had kind of Greeks that really could move on you in that those last few hours. That's changed a lot now because customers love trading the 0 DTE, and so we see these positions, you know, that you're tracking and that, you know, that we're tracking, that do result in basically hedge positions that they need to be taken off. I mean, that's kind of the simple answer is, you know, if they've hedged short calls by buying futures and those short calls expire, the delta disappears because they're cash settled. They got to get out of the futures. So there is that residual trading that goes on, and that's also one of the reasons that, you know, we see Friday volume is kind of always higher than the other days of the week. Although you know, with the daily expirations, it's kind of quickly getting pretty equalized.
Yeah. So I guess here's the next question: do market maker, you know, this is kind of a perception in, you know, retail land especially, that market makers never lose money. Do they, and how?
Market makers definitely lose money, but they have enough scale in their business. It's a little bit like, I mean, most market makers think of it as being that they're the casino, right? So they have an edge as long as people are playing millions of hands. On individual trades, they get whacked. They get whacked because the stock moves, the underlying moves. They get whacked because volatility makes a big change on them. You know, but the model is to be constantly trying to neutralize your exposure. So if you're selling a bunch of options, whether they're calls or puts or both, you know, think of it. We used to have it at one of the shops I worked at, just a simple inventory constraint. Like literally every 500 contracts we were short, we would add 2 cents to the theoretical value. So even though we knew it was only worth $1, if we'd sold it, you know, enough that we didn't want to be selling anymore, you know, maybe we've added 6 or 7 cents to that theo to bias our pricing, and all of a sudden we're a 101 bid, because even though it's still worth $1 in terms of our modeling, we don't want to be shorted anymore. So basically, you know, inventory is the risk that a market maker has, and they can get hurt on it. But if you think about it, you know, with 70 million contracts trading a day, you know, there is a bid offer being paid on every single one of those trades. Okay, it may not be big. In some cases it is. In some cases it's super duper small. But they're starting out with, we have a measure that we've captured for decades, which we call total edge, which is simply the difference between the theoretical price, right, which you're getting on Valera, and the trade price. And so you can add that up and you can say, okay, well, in this trade it was worth $1, it traded for $1.03, so somebody made $3 a contract, it was 10 lots, you know, $300. Add it all up, you can do some neat things with it. You can figure out what the average edge is for a symbol, for an expiration. You can total it and say, oh wow, the, you know, market's got, the last time I looked, I think the market is running with around $80 million a day in edge that's available to the market makers. Now that's a raw measure. It's not they're not capturing 100% of that, right? Whether they're hedging or they're just kind of getting a little bit beaten up on being wrong sometimes. You really have to kind of haircut that down to maybe 20% of that is attainable. But yeah, market makers are wrong. I mean, it's just that they're also making so many trades that the wrong ones, fine. They do fine on 92%, and they're wrong on 8%. And I think you and me and all of us, we go try to be that 8%.
Yeah. Yeah, so I did want to take a look real quick at Volland. I'm going to share actually my 0 DTE, and I wanted to get your take on some things that we've noticed over the past couple weeks. Right, like for instance, right over here, I mean, this is a charm chart. If I looked at Delta, it would be more pronounced, but we're noticing a lot more premium selling in the wings. And kind of the real big change that we've noticed is not just that the premium selling in the wings, but the fact that the wings are able to be sold. Skew has gotten a lot wider, a lot more kurtosis especially in the 0 DTE tenor. Is that something that you've noticed, or is that in the flow?
Yeah, I mean, we do, there's many different ways to kind of, pay attention to skew. Some people do it in a really rough 10% out of the money calls and puts. It doesn't work on a 0 DTE. It works fine on a 30-day. We have noticed, I mean, this summer, the skewness was very flat, right? The market, was basically didn't seem to be concerned about, much of a correction, much of a downside. I think that, there's a big difference between the 0 DTE kind of world and expectations and the 30, 60, 90 day. I mean, there's a VIX 1D and there's a VIX. Same kind of thing. There's skewness and kurtosis in the short dated. That's, I think is that because it's resetting every day, right? And people are coming in using the 0 DTE for kind of tactical hedging, right? They're basically looking and saying, this is what I think is going to happen today in the next 5 hours. So there's kind of a baseline of we know there's condor sellers that kind of show up every single day. We see that in the time of day that the trading's happening. In terms of the skewness, though, we saw it go from pretty flat to we're back to especially after October 10th, I think was that pretty sharp down Friday. People get a little spooked, and I mean, market's up 16-something% year to date. A lot of people calling for maybe a correction, calling for things being overvalued. That's always the cycle, right? You get headlines about how bad things are, and then and you get kind of the flip side of that, which is people basically need to be invested in equities, and they're going to keep doing it. They're going to keep buying the dip, and so. But we have noticed kind of the same thing in some of these interesting kind of shifts to where people are kind of picking their spots, especially in the 0 DTE.
Yeah, I mean, in the farther out tenors you were just talking, I mean, another thing we noticed is a lot of premium selling. Now, this is Vanna as opposed to Charm. We've noticed a lot of premium selling on the monthly tenors as well. And it's been, again, on the very wide areas of the wings. I think at times there's like bad, quote unquote, bad news, tariffs and stuff like that. And yet the market is still kind of pressing all-time highs.
Yeah.
I think when that started happening, when we hit like 6,900, we saw a shift in this curve go from everybody's buying puts, everybody's scared of a Trump tweet or whatever they call it again. And it turned into all of a sudden people think the market is immune to any news, and it's shifted to like premium selling. Is that, is that something that you've kind of noticed, or is that?
Yeah, I mean, it's yes, I think that like forever, the market it's fear and greed, right? And it's also a lot of habit, right? So this the buying the dip has been a been spectacular for several years now. So it's worked, and people have made money at it, whether they're lucky or whether they're just kind of their just reactions have been correct. There are really structural reasons the market just goes up. We've seen it. If you read stocks for the long run, market goes up. The value of the economy goes up, the market goes with it. Yes, it gets overheated. We get sharp sell-offs. It's very easy to get terrified. It happens to everybody. It happens to the best traders. I have a good friend who I traded with for years, who runs a fund, and he's been in the market for 40 years, just like me almost. And he would get spooked, and he would buy puts, and basically generally those would not make him any money. And he actually shifted to buying, every time he was about to go buy puts, he would buy dehydrated meals and put them in his closet, because he's like, if I'm hedging for some sort of disaster, this is a different way to do it. And I think it's funny. Honestly, I think he gets the same kind of like, okay, I've done something to kind of cover my butt a little bit. I'm not saying buying puts never works. I have a slide that shows how you would have done in April, before Liberation Week, and there were some puts that went from 60 cents to about $300 in SPX. So enormous kind of convexity there.
Yeah,
but,
right before that Liberation Day, and that Liberation Day was coming. Like, we knew that day. And puts still weren't priced up. Like, they weren't expanded. You were talking about a metric that you keep track of, which is total dealer edge. We kind of keep track of something similar. We have like the total net dealer premium. So, obviously the total premium that dealers collect if they are selling the option or they end up buying an option. It's the net of that, and that includes intrinsic. We will have strictly extrinsic soon. And this one, which we actually have to get more of a history of, but we have the delta adjusted dealer spread, and we call that kind of like our liquidity. You were talking about a little bit of price improvement. This is the edge that the dealers have. So we have the Theos as the fair price, and the distance between the Theo and the execution price gets multiplied times 1 minus absolute value of delta. And that becomes, we average that all together for delta adjusted dealer spread. So this is kind of like our own like kind of in-house dealer edge metric that we use. Again, we have to get some more history in order to get more accurate, but this number typically is like an 8 to a 16 kind of area. It does correlate very well though with VIX. So like as it shoots up, VIX shoots up as well. So
right.
So just kind of giving some Volland equivalents to things that you're talking about. Hunter, it looks like we kind of hit your target and then bounced. Did you take a trade?
I did. That's why I've kind of been silent over here working. So
yeah, Hunter's target was like, he said, what, 68.30?
68.30.
Yeah. So what was our low here?
Like 68.30, about 70 cents. So almost right to it.
Yeah, there you go. Hunter's, so just so everybody knows, live update, Hunter's in a trade. All right. Did you have a question for Henry, Hunter?
I just had one. I'm not sure if you can answer it, but one thing that I was very curious about is like when we have fall shocks in the market, how do market makers really react to that? From a quoting side, one thing that I sort of understand is that size is sort of discretionary to the market makers. So like, how do they work out their bids and their offers when you have these volatility shocks? We've had some pretty big events this past year, especially with the Trump administration, the tariff policies in April. Like, how do market makers really react to these large fall shocks? How they start working their offers? How they know when it is to tighten those spreads again, but also tighten that with size, right, and then start to work volatility back down?
Yeah, it's a good question. I mean, there's an old poster on the wall at one market making shop, and it said, "When in doubt, widen out." So what, when you don't know what's happening, you just want to blow out your markets. When you get, when you get a dislocation, when you get a shock, right? It's a combination, right? There's competitive, factors, right? Market makers aren't going to trade unless they're kind of on the inside quote. So if you get nervous and you just widen out, you're you're outside of kind of the quotes, you're not going to get hurt the same way, but you're also not going to be participating. You're basically missing out on kind of the trading opportunity. So part of this is really the market is kind of dynamically, in fact, the market makers have logic to basically match the best market, right? If the market's 12 cents wide, they're going to say, okay, well, I want to be 12 cents wide. Maybe I want to be 10 cents wide if I want to be, kind of trade more. They do, they have proprietary kind of measures of what sort of edge they need in terms of vega. They're watching what's happening with the stock. So in a way, like, remember, an option's a derivative. So if the stock is trading, a penny or two wide, that does translate to, a width in the options. Just even if you just theoretically said, well, if I sell calls and got to go buy stock, there's a penny. And if I buy calls and have to go sell stock, there's a penny. So you're certainly going to build in, the penny, and in terms of, times delta, whatever you need for the options, just to simply break even. So when the market starts to get really, really rocky, stocks themselves widen out too. So the stocks widening out means the options are going to widen out. In terms of the sizing down, I don't know if there's anything super scientific about it. I just know that it goes down. I mean, when you look at 2020, the average size market wide, I had a chart, had been around 2,000 up. Okay, so 2,000 contracts shown on the bid and the offer across everything. It's kind of a rough way to look at it. It went from that down to about 400 contracts up. Okay, so 3/4 of the kind of displayed liquidity disappeared, and was gone for basically 3 months. And it takes a while to come back. And so again, it's there's also a factor with, certain exchanges have a pro rata allocation mechanism, which means that they, even if somebody sells just a 50 lot of options, it's divided up based on how big each market maker's quote was. So if so you have to kind of quote with competitive size to get a decent size of any decent trade that's coming in. And so, so everybody kind of sizes down, but similar to the width, I guess there's a little bit of just a market equilibrium where, kind of people widen out together and people size down together. But it reflects the uncertainty, right? I mean, think of like vol of vol, right? Like if vol of vol is, is low, is like, 80 or something, you're going to be kind of comfortable taking some positions if you're getting lifted. When vol of vol is 200 and you don't know if VIX is going to be at, at 35 or 20 by the end of the day, you have to be small, just because remember the whole point of being a market maker is they really are not trying to take much of a view. They don't need to when you've got 70 million contracts a day. They really just want to kind of capture as much as they can. And the way things have evolved, they're able to capture, even a spread that's a penny, they're able to actually capture a chunk of that. And then there's so many contracts trading, it really does add up. And so they really don't want to take the kind of risk. So that's why they widen out and size down, because if it turns out the next 6 trades are buyers, and the liquidity of everything is going down, everybody knows the volatility could really move on them. They could get hurt. So hope that helps.
That does. Thank you. Jason, sorry, your audio was out there.
Oh, my audio. Oh, my wife mutes my mic whenever I'm making noise. So, all right. She mutes my mic in real life too.
Yeah, I was gonna say.
William had a quick question because this was related to something you said before. The deal that they give to Robinhood based data because it's retail that they are, quote, not afraid of, what you said. Is that based on the idea that retail is kind of dumb money? And I guess a follow-up question for me is, who are you afraid of? Like, where's that flow coming from that you are afraid of?
Right. Yeah, and it's not that retail's dumb money. It's less informed. It may be just simply people that are long some Nvidia that have made some money and want to sell a call. They don't know anything about where Nvidia is going to go. They just want to sell a call. So they're not really very price sensitive. They're not contrast that to and it's also very two-way, right? You have somebody else, some other retail customer who wants to speculate on Nvidia. So that retail flow tends to be very balanced and less informed. Who they don't love trading with, and so in fact, there's 606 dealer reports which are published. They show, you can Google it, Robinhood, and I'm just using them as an example, and all the other kind of e-brokers that take this payment for order flow, and that really is most of them, because this is how you get to low commissions. Is you get low commissions because the consolidators are paying something for the orders. Okay, this is how it's worked now for 8 or 9 years, and I don't think there's any going back. You can see which you can actually even see which brokers get paid more. So there's a good academic study that I read, basically comparing the payment rates that the brokers are getting, and there's some such as like Fidelity or Vanguard. They get very high payment rates because their customers are very, very attractive to a market maker. The opposite of that is very smart, kind of prop, professional for sure. Like I said, the example I used before, market's 1 to 110, they'll sell it to Robin for 107. If some hedge fund calls and says, okay, I want to buy 8,000 of these, they're going to say, well, that's $1.20 for you, because I think you've probably done your homework. And and in fact, there's pretty sophisticated tracking of accounts out there at kind of the high touch broker level, shops like Goldman and Barclays. They know who their customers are. They know what their customers are good at. So if their customer says, I want to buy 8,000 of these, they actually keep track of, like, okay, this customer's been right 62% of the time in terms of direction. So we may trade with them. They are a customer of ours. They're willing to pay. They're willing to pay the price we give them. But they might even overhedge the position. They might say, this person's usually very good, so we're going to sell them calls, and we're going to double hedge the stock. It happens. It's pretty interesting. So the way that the consolidation world has kind of bifurcated the market. There's an institutional flow that they basically pay up to get a trade done, and there's a retail world where they're basically they get a very good experience, because getting in and getting out of trades, they're not getting kind of squeezed for sometimes in the olden days, customer might make money, but the bid offer was 20% wide because they bought a call for $1 and it went up, the stock went up, and then when they want to get out and the thing's worth $1.12, it's only $1 bid. The customer's like, I got it right, and I still didn't make any money, and they had to pay commissions back then. So so that's kind of, it's not so much, I don't like the phrase dumb money. It's not that it's dumb money. It's just that it's not informed, and it's very balanced. They would take, I mean, there's some smart people trading through Robinhood accounts. There's some big Robinhood accounts. So it's not that the Robinhood traders are losing all their money. It's just that you can kind of count on, if you do the other side of every single Robinhood option trade, you're not going to get into some nasty position that's going to hurt you.
So from the Kyrios standpoint, what should I look for that market makers are targeting me as too smart? No, I'm kidding. Hunter, did you have one more question?
Hey, Henry. So another question too is, when we're looking at the market maker book and we're looking at risk, the same market maker is quoting probably 1,000 option symbols out there. Do they really look at that from like a portfolio level when they're looking at their exposure? Like, hey, let's look at our complete deltas, and they're going to quote it by all the option symbols in SPX as an example. Is it more about the risk on the strike level, or is it more at the portfolio level?
It's both. Okay, they're continuously doing kind of risk slides, right? What happens if we gap down 10% and volatility triples? They always know kind of that scenario, right? And there's a ton of work. That's what the risk departments care about. And same thing. If we run up, I don't think about anti-liberation day or whatever the other day was in April, and we ran up 10%. Same thing. It's like we every once in a while markets have these kind of mind-blowing moves. But they also do, especially in the zero DTE, primarily in the zero DTE. That's where strike position limits are really closely watched. And so most of the market maker shops that I know, they have a zero-day desk, and then they have the volatility trading kind of portfolio, which volatility doesn't mean too much when you're talking about something that expires in 2 hours, right? It really is simply I'm short the 7,000 calls and the market's at 69.91 and we got half an hour to go. Like, yeah, you could probably give me a intraday volatility measure that's going to say what the likelihood of that happening is, but I think of it more like sports betting. Like, what are the chances that the Jets come back in the last quarter?
Never
given
good.
all these, yeah, no, they don't do that. But so the zero-day desks do have strike position limits internally, and we actually see the impact of that in the fact that one of the numbers that we publish, it's in the open close file, is market maker, firm, customer, and you can add it all up, and over time, especially in the zero DTE, you see much more market maker to market maker activity than you see in anything else. Because market makers in general, they're all kind of doing the same thing. They're trying to model volatility to make a two-way market. So they're very unlikely to bump into each other. Zero day, it's a totally different story. If you've traded your book for 5 hours today, and then you find you're short 600 of the 5850 puts, and your limit is that, you might say, I'm going to go buy these back. I don't care who I'm buying them from. And so that results in this, the biggest growth we've seen, the market volume is up 22% this year, but when you kind of break that out, it's customer, but even greater than customer is actually market maker.
Mm. All right. So we can go all day on this.
We should.
We do hope to continue this conversation another time, but yeah, and by the way, for, in the comments, somebody asked, is this recorded by chance? Yes, it is. The same YouTube link that you're on right now will have the recording. So, all right. So thank you, everybody, for joining us for this segment of Volland Refined. Thank you to our guest, Henry Schwartz of Cboe, for joining us. If you're watching this on YouTube, you can go to the description of this video to get the links to all 8 segments. And don't forget, you can subscribe to Voland at whichever tier is best for you at www.vol.land. Thank you, and may Voland help you in your future trading ventures.